Well, U.S. stock futures are lower across the board this morning. For the U.S. major averages, we're taking a look at some declines of 0.8% for the Dow, 1.3% for the S&P 500. NASDAQ futures down 1.9% just inside of 30 minutes until the start of trade. We've got some fresh data Wednesday morning showing the U.S. economy contracted for the first time in 3 years as President Trump's trade policy took hold. GDP decreased at an annualized 0.3% during the first quarter. This is according to an initial estimate. An upturn in imports subtracted nearly 5% from the metric, the most on record. Gus Faucher, who is the PNC Financial Services Group chief economist, joins us this morning. Gus, I just want to get your reaction to this print this morning.
This is very difficult to interpret. I mean, obviously, trade was a huge influence. We saw companies bringing in a lot of imports to try to get ahead of tariffs. We saw a huge build in inventories. But when you look at underlying demand, consumer spending growth, that was still pretty solid. So it's going to be interesting to see what happens over the next couple of quarters and whether that solid demand holds up or whether we start to see consumers pull back, businesses pull back because of tariffs. But I think overall, this is indicating that tariffs are having an impact on the economy, that it's been negative so far in 2025, and they're likely to remain negative in through the rest of this year.
Gus, as an economist, you know that the definition of a recession is a little bit more broad than what I'm about to say, but the kind of colloquial definition is 2 consecutive quarters of negative GDP growth, and then the NBER has a ton of other things they look at, and they declare an official recession. Is this morning's GDP contraction a signal that we are on track for that recession?
I don't think so, because when you look at the broader indicators that the NBER is looking at, employment, industrial production, retail sales, consumer spending, they all look positive. So this quarter of contraction, that's due primarily, almost entirely to net exports, the fact that we had a lot of imports coming in. I don't think this is indicating that the economy is close to recession right now. We would need to start to see some softness in those other things, in employment, in consumer spending, in industrial production. We're not seeing that yet. And I think when you look at the deeper into it, I think the economy is still expanding, just that trade is having very broad influences that are making the numbers difficult to interpret.
You know, Gus, with that in mind, on the employment front, we did get some private payrolls data out of ADP this morning. Private employers adding 62,000 jobs in April. And as you were thinking about employment and reading through even some of the commentary that we're receiving over the course of this earnings season from CEOs, their outlooks are not clear at all, it seems, at this juncture, which could have a broader overhang in the near term or long term for some of that employment situation. How are you kind of pairing some of those comments with how they're looking through the workforce that is necessary for their operations right now?
That's right. I mean, we continue to see initial unemployment insurance claims that are low, so we don't see a lot of layoffs, that are related to tariff activity. I think that businesses are waiting to see what happens with tariffs. They're not doing a lot of hiring, but at this point, it doesn't look like they're laying workers off either. As long as we continue to see employment increase, that means household incomes are going up, consumer spending is going up, and the economy should continue to expand. But if we see businesses that are being negatively hit by tariffs, if we see them start to cut back on employment, then I think we have to be much more worried about the potential for recession in the U.S. economy.
And Gus, the market is currently pricing in about 100 basis points of cuts this year. How much more pain do you think the economy would have to be in to get that degree of cuts from the Fed?
Well, certainly we'd have to start to see some deterioration in the labor market, and that hasn't happened yet. But I do think that over the next few months, if we start to see initial unemployment insurance claims increase, if we start to see weaker jobs reports, maybe job growth slowing to well below 100,000, the unemployment rate starting to increase, then maybe we could see the Fed start to cut sometime in the second half of 2025. But given the inflationary impacts of tariffs, I think they want to see some sort of deterioration in the labor market before they start to cut again.
And Gus, I want to get your reaction to a comment that was made by President Trump at a rally on Tuesday. Trump continuing his criticism of Fed Chair Jerome Powell. Take a listen.
Interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
Spoken like someone who spent their career in real estate. Gus, to what extent do you think there is a real concern, especially amongst investors kind of fleeing U.S. assets to a degree, about the Federal Reserve's independence?
I think that is a legitimate concern. I think that one of the things that has served the United States well is the independence of the Federal Reserve from political pressures. I think it's highly unlikely that President Trump would actually try to fire Chair Powell, but certainly Chair Powell's term expires next year. I think that the president will try to replace him with someone who's more on board with the president's thinking. And I think that that doesn't bode well for U.S. long-run economic growth if we see more political control over the Fed.
Gus, thank you so much. Appreciate your time.